Hey guys, today we have something a little bit different. I'm going to be going over some of the most important psychological rules and trading rules that you should be implementing into your trading. Now, let's get straight into it. Right here, I have a little whiteboard. I'm going to be giving you some visuals on why it's important to have these rules. Now, the first thing that we're going to be going over is risk management. Now, something that I like to implement on all of my accounts is having a personal daily loss limit. What does this mean? This means that I can't lose a certain amount in a single day or else it's going to lock me out of that account. So for me, typically if I'm trading a 150K or if I'm going a little bit more aggressive, then I like to have a $600 personal daily loss limit. Now, what this allows me to do is limit my overall risk. Now, imagine that you're trading, you're having a bad day, you take two losses, they result in about a $600 loss. Okay. Now, the instinct that you might have is to continue trading. Say you still have targets, you still have a lot of confidence in the setup. Well, a lot of the time, if the move didn't happen within that first or second swing, then it probably wasn't going to happen in the first place, or it might happen later on in the day. So, a lot of the time, it's better just to step away, take that personal daily loss limit, which almost every platform has it now. What it does is it basically blocks your account for the day, so you can no longer trade. Now you might be wondering, oh Chris, well I want to continue trading. What if I want to trade the other sessions? Well, you probably shouldn't be trading at that point. Your psychology is not going to be as good. You aren't going to take the best of setups because you're trying to make back that loss. And overall, just wait until the next day. Do you guys not have the discipline to wait until another day, find some higher probability setups? Now, on the conservative side, I would say about a $400 daily or personal daily loss limit would be ideal. Now, that would be for like a 50K. So let's say you're risking like 150 to 200, and sometimes even if you're risking 150, it's going to go a little bit over because when it comes to futures, it's not perfect in terms of like the amount of micros you could have. But anyways, that's a perfect mixture of not blowing the account. You're using about 20% of the account if you're having a really bad day, and that's absolutely not going to ruin you. Now, I see the main issue with people is that they're going to use as much risk as they can in a single day. Usually, most prop firms have like $1,000 max daily loss limit, and that's saving people. Honestly, it's better that they have that in place opposed to them not having it, because I see so many people going through the entire drawdown in a single day when that is not logical whatsoever. You're not going to find enough high probability setups where you have to use that much risk. On a good day, you're going to see one or two good setups, and that's it. That's the reality of trading. So, that is rule number one, risk management. Now, the next rule I want to cover is based on trading. It's going to be sessions and setup. So, most of the time, we have a lot of people in our Discord. They want to trade every session with us. We have multiple educators. Everybody's good at trading. We're all taking pretty decent setups. But what is the reality of how much you should be risking and what setups you should be taking during each session? So, let's say you take two trades every session. So we have New York, Asia, London, and each of these sessions you risk $300. Let's just say you're trading a 150K. And that's per trade. So imagine you take six trades across those three sessions. That means you're taking a total of 1800 of drawdown if you took a loss, which isn't very practical, right? But overall, you're taking $1,800 worth of risk. That's a lot of money. You're risking almost half the account right there. Now, what should your approach be when trading these sessions or even watching people trade these sessions? Well, it's okay to watch them, but you don't have to execute on every single one. Here's some very sloppy diagrams of what each session looks like. So New York session, it's going to have nice steady movement. It's going to trend in one direction. Typically it'll take out some liquidity, but once it starts moving, it starts moving. Asia session usually accumulates. It'll kind of have a really small stop run and then it runs. Now, I know for me, New York session is going to be my bread and butter. I'm going to look for some type of IFEG after that liquidity sweep, target some relative equal highs, maybe a previous daily high. And so that's a consistent process for me where I know if I trade Asia, I'm not going to trade the best. I know if I trade London, I don't even know how to trade London, right? What this allows me to do is it allows me to scale. When I'm trading New York session, I know what to expect. I know what to expect every single day and how to limit my overall risk. So that means I could take on risk across 10, 15 different accounts. Whereas Asia and London, I'm not as confident. I'm not as confident in the movements of Asia or London. Asia session, it typically accumulates in like a higher time frame, fair value gap, maybe like a order block, and then it decides to run. That is not really my cup of tea, especially because the lower time frames usually really sloppy. And so, what should you be doing when you're watching us all trade? We have four different educators. Well, you should be just watching. You don't have to take every single setup. When I was watching traders trade live on YouTube, and for a long time I did, that helped me build my setup and my overall confidence in the market, how to actually approach trading. I wasn't taking every single trade that they took. They built up their own intuition, and I don't deserve to take the same setups as them because I didn't come up with that trade idea. They have their own way of coming up with trade ideas, and if I try to replicate them when they're not there, it's not going to be the same. So you have to learn how to take your own setups, how to have a consistent process, and where that starts is trading one session at a time. For me, again, it's going to be New York. I'm going to trade a IFEG, a fair value gap. They're basically the same thing. I use a liquidity sweep, some higher time frame delivery, and then I'm ultimately looking for those two PD areas to enter. Now, rule number 3, stepping away. Right here, I have an example of two different types of traders, trader A and trader B. Trader A is impatient. He's looking to trade every single day, and he never takes a break. Maybe he's looking at every session, and he's okay with taking multiple losses in a single day. Whereas trader B, he's patient, he's waiting for high quality setups, and he's okay with stepping away when it counts the most. Now, trader A is going to take a $1,000 loss on Monday. Why? Why is he taking $1,000 loss on Monday? Well, probably because there was no news, there was no high probability setups. A lot of the time, Monday is going to be consolidated. Trader B takes no trades. Now, trader A takes a $2,000 win on Tuesday. Nice. He took a really nice 1-4. Now, trader B took the same exact trade. Trader A is going to take another loss trading on Wednesday. Maybe FOMC was going to be in the PM session and it's choppy. Well, trader B decided to take no setups. Now, trader A is going to take another setup right here. Maybe he makes 1,500. Trader B, he's going to take a small win. Trader A, he likes to hold these long extended moves. Maybe they hit, maybe they don't for him. But trader B just wants to take a nice little base hit. And then trader A, again, takes another loss on Friday. Why on Friday? A lot of the time, Friday can be consolidated just like Monday. So the big chunk plays that he was taking, a $2,000 win, a $1,500 win, he's only going to end up with $1,000 at the end of the week. Not good. If he wouldn't have taken those wins, then he would have been down exponentially on the week. Whereas trader B only took 2 trades and he was up $3,000. Now, trader B knows when to step away. He ended up with $3,000 on the week. He knows when there's bad price action, he shouldn't be trading. He looks at the news and understands when price might be consolidated, when his highest probability setups are not going to be present. And as a result, when he has those nice big winning days, he's able to retain all of those profits. Now, I see so many people giving back profits, taking unnecessary losses when they don't need to. A big thing that might help you is just understanding the economic calendar. I know if on Tuesday there's a major impact day, but on Monday there's nothing, Monday is probably not going to be too nice. Tuesday is where we're going to want to wait to use our full risk. So I'm going in light on Monday. Wednesday, Thursday might be better, but I know Friday is probably going to be consolidated. So you just have to have that patience and wait for those proper setups to form. That's going to allow you to pass accounts, get payouts, but ultimately you can't be fully focused on trading every single day. What I mean by that is you shouldn't hold those losses and think about them all day. You shouldn't think about when are you going to take that amazing back setup. It's going to happen. It's going to happen eventually, but you can't purely be focused on that.